So welcome to my portfolio update video. This quick expert poll shows that 60% of your portfolio's gone up in July, but 40% of it's gone down. So this video answers the question, how is my portfolio performing? How's it done in July? And am I on track to meet my overall long-term investing objectives? The story of the wider channel is that by ideally 2050, I want to hit a £1 million investment portfolio. So this video will track how I'm performing against that. I'm only 2 years in, so there's a long way to go. As Terry Smith says in the Investing for Growth book, if you take 1 year, that's an arbitrary amount of time for the Earth to go around the sun. What's that got to do with an investing time horizon? You should be looking at things, 5+ years really. But I want to keep the transparency going, so I'll keep these monthly updates going. You can see what's moved in and out of the portfolio, and it keeps me reviewing the positions so I can share my thoughts on them with you. The positions you'll see today are split to US portfolio, Asia Pacific and UK portfolio. So I'll go through all of the holdings in those portfolios and share the performance in total and the change in the last month. Stick around to the end to see how I'm doing against the goals. But what we'll do now is we'll dive into the screen and I'll take you through those performances. We start with my American portfolio, which is getting on for £18,000. That's 45% of my overall portfolio. And we're going to start with the largest value holding and then go in descending order. So we'll start with Alpha Metallurgical Resources, Met Coal Miner. Almost £3,000 this position. It is my largest holding. And the performance has improved since last month by 24 points. So at plus 224% on this one. Big day coming in about a week's time when they release the next quarter's earnings. I'm hoping for earnings per share for that quarter around about 30. And that could push the stock price up a bit more. It did hit a high a couple of months ago of 186. It went all the way down to about 108. We're now in the mid 130s. And based on the performance of the company, the forward PE is no more than 2. It's probably closer to 1. Really interested to see what happens in this cyclical. And if it does move towards that up to 200, then I'm going to start thinking about closing that position off, because the thing with the cyclical is at some point it needs to be sold. Bank OZK is a very good management team, one of my favourite holdings, pays decent dividends. Almost £2,000 in it. 76% total return, up 10 points. That does include dividends total return. This is a long-term hold for me. That value there is around about 5% of my overall portfolio. I'm very comfortable with that. Goodham Group is another long-term hold. It's probably undervalued to an extent. Dividend stock, turn of plus 66%. In the market, it's been down 9 points in month, but you can get normal fluctuation. I do like the long-term prospects for the dividends, and I think this could be a nice compounder. Now, Dropbox, again, one of my favourite companies, which is why it's one of my bigger American holdings. I'd probably like to have a double position size in this one, actually. I'm only up slightly, and if the stock was to pull back at below 20, for argument's sake, there's a decent chance I'd add to that position. Happy with the management team and happy with what they're doing. Also, gaming is an interesting one. I use their products and have done for many years. Really like their products. They are a leader in many fields. There is a moat, got about £1,000 in it, so that makes it, 2.5% of the portfolio, give or take. I'm down 41%. I bought in too early, really, based on that. And I'm going to average down, probably not at the moment. If the stock's around $14 here, if it goes to that sort of 10, 11 region, I probably would just average down a bit, because I'll be almost sort of 50% down then. I do like the product. Probably going to struggle a bit. You've got potential recessions coming, inflation, but if the company's got a moat, is a good company, the products are good, then kind of wait through that difficult period. Now, Walgreens, slightly down in that position. They pay a nice dividend. The management's good. I like the plans they get for the company, so happy to hold about 2.5% of the portfolio. Micron has improved its sort of market view, market price in the last month. I'm 15% down on that. Likely to continue holding, but I am conscious that I'm doubled up because I've got Intel. Maybe thinking, do I need both of those? Probably in the long term, they'll do very well, so likely to carry on holding. Anthem, or Elevance, that's how you pronounce it, that's what it's known as now. This is a very nice kind of long-term compounding stock, up almost 60% on that in a couple of years. And yeah, just going to carry on holding that, happy with how they're performing. So I've got Legal & General US Index, so I can't guarantee to myself that I am the best stock picker, that I'm going to outperform the index. I would hope to over a long period of time, but I don't know that I'm going to. And then this index holding, and I've got a couple of these scattered across the portfolio, it's almost a bit of a protection in case I muck up and go wrong, because that's certainly possible. I'm not a professional. None of these obviously are recommendations buy or sell. So having the index fund in there is my protection against failure, as it were. And yes, it will draw my overall portfolio returns. If I underperform or overperform, it will draw it closer to the index return. From a risk management perspective, that's why it's there. It's gone up quite a bit this month, the S&P 500, but that's £700 in that index fund. Cumulus Media, I have added to this position since last month in the sort of $7 range. I think this is a really undervalued company. They're turning around nicely, and at some point the market is going to recognise this, and I should be quids in, if as it were. Just over £500 in it, down a little bit, but I'm not worried about that. I'm going to carry on holding it, and again, if it drops further, I may add more. Now, InMode's an interesting one. It has been by far my favourite growth stock. Very profitable, expanding nicely, and I've been averaging into it. They released some results recently. It absolutely kick-started the share price performance, up 34 points in the month, so total returns plus 15%. And the value, though, is £546, because I actually sold half of my position the other day in InMode. Perhaps a surprising move. And the reason for that is I saw a video from another YouTube guy, Sven Carlin, who's got about 200,000 subscribers, but some of you guys may watch his videos, and he actually reviewed InMode, and he's very, very good researcher, and I trust his sort of research and risk averseness. And I thought, from risk management perspective, based on what he came back with, I'm going to halve that position. I'd be interested to hear what you guys think about that if any of you are on InMode. Kind of got caught between two places here. US Bancorp, that is, yes, just carrying on. Hold that. That should tick over time. I believe Berkshire holds them as well, which is a good endorsement. Do like American Express, £500 at it, up 73%. It's had a good month in the market, up 16 points. Again, a customer, very happy to carry on holding this one. Just wish I'd put more in it to start with. I really do like the company. And again, a big Berkshire holding, so what bigger endorsement can you get? Speak of the devil, here we go, Berkshire Hathaway. Good month in the market, good performance in the 2 years I've held this one. Again, should have bought more at the time, but there we go, that's how these things go. Probably not time to average it at the moment, but this is likely to be held forever in theory. Now, turning to fintech, probably one of my biggest mistakes so far, not necessarily in terms of the performance, because in large portfolio positions, are going to be returns that are low. The management's been mixed on this. They kind of buggered up, if you excuse my French, a listing to NASDAQ. They have cut in the last couple of months their forecast going forward considerably, and that's caused the share price to absolutely tank. So the management haven't been able to perform as they previously set out. So have they sold a story and not been able to deliver against it? And the mistake that I made, because you can't necessarily predict management in that sense, but I didn't buy it with a margin of safety. So my first purchase tranche was at too high a price. And now, of course, that total return is minus 73%. And if I bought with a margin of safety, that should have been lower. And actually, I kept averaging in when the chance came to lower the average cost. Whereas if I bought with a margin of safety, I wouldn't have had to average in so much. So the actual return in absolute terms would be better as well. So I'm keeping a very close eye on this one. It still has something about it. I think they can still put it together, but they really do need to now start delivering against their forecasts. Intel, I do like Intel, 24% down. If this is very close to rebuying, I think the price is 36 or so in the market at the time of recording. This goes, certainly if it goes to 30, I'll be buying. 35 was my kind of trigger point for a closer review. I'm going to start looking at this again, and I may well add to the position, but noting that Micron is there as well. So am I overexposed to the sector? Probably not actually, because there's only £1,000 in Micron, but I will keep that in mind. So we're on to Ramaco Resources. Ramaco Resources is my other met coal producer. I actually sold half this position, and a massive exposure to coal at one point. It's around about 10% the value of my portfolio. And given these are cyclical companies, there's the risk that if I'm not careful with when I sell, then actually the portfolio could be adversely impacted. Now, up about 200% here, but I did bank half value, so £400 or so. The reason for this is they had an adverse methane ignition, words to that effect, material methane ignition. and checked a couple of times. I haven't seen any further news on that unless it's counted the last day or two. And one of their mines, when it was idle, had an explosion. Basically, their company hadn't released their kind of view on what that meant for the numbers. So as a kind of risk management thing, again, I've halved that position and taken some profit off the table just in case it ends up being really bad. Now, I think there's still probably another double in the stock here, but I know overall I can't lose money on the position now based on what I've taken off in profit. So GAN, that's probably the second notable error in that I didn't buy it with a margin of safety. And I think my learning here, which I'm very conscious of, is growth stocks, I'm not very good at picking the entry point. So it probably means I should stop buying them, particularly these earlier stage ones. I need to try and write up a checklist for myself, I think, just to make sure I'm not doing that again. But still, I think the company has potential. A bit more US index here, 370 odd pounds, up 23% on that. So again, I'll just hold that. I'm not right. Seritage up 45 points in month. It's been a really good month for Seritage. It's now just minus 11%. This was one that was absolutely collapsing in share price. There's been sort of changes in terms of strategy and management, and that's absolutely had a massive impact on the stock position. I think they're essentially going to try and liquidate the company. It's going to take too long, it'll be too expensive and too difficult for them to renovate all of these properties in all the different states with all the different laws, all the different contractors. So there's a chance of actually making a touch of money on this. I mean, potentially there's up to a double still in the stock price if they get a good value for all the properties. Given what we're about to head into, possibly, difficult periods with rising interest rates, maybe it's one to just sell and lose that 11%. It's not very much, and just protect the capital. So I'm having to think about that, but that could be a change potentially in the next month. Getting towards a smaller holding, Stern Rubin Co. is a very much undervalued company with a very nice dividend. It's up 11%. Turtle Beach are down 30 points, but there's an activist investor in there. There's some sort of changes in terms of what they're trying to do with the company. Maybe an acquisition that's kind of been on and off over time. But there could be a special situation potentially, which is why I'm carrying on holding this one. But I would like to lose it from the portfolio this year. And Altisource, right, I'm just back into profit on that one. And this is, I call this a cyclical stock because if there's a massive amount of housing foreclosures or difficulties in the US, this stock will benefit massively, this company will benefit, and therefore the stock price should as well. So there could be a quick sort of 2, 3, 4x potentially in the best case scenario if unfortunately the worst happens and the economy there does, the housing market there does to struggle. So there's a little bit of a hedge, I suppose, if things get really bad. And yes, a mistake. Well, mistake in hindsight. Voyager Digital, company's basically bust. It's a bit annoying. So this could be my first sort of total loss potentially. I say it's a bit annoying because I was up 50% on this position at one point. So disappointing. Luckily, it was one of my smallest holdings because there was risk associated to it, so I kept it very small. But rule 1, don't lose money, has been failed on this position. Right, onto the UK portfolio. Now, that's got up about £500 this month, and it's around about a third of my overall portfolio. FTSE 100 index is the largest for reasons, as we mentioned before, £1,500. Again, just going to carry on holding that, should tick along nicely. Boohoo second, again about £1,500, down just under 2/3 on this. Again, the first purchase wasn't made with a margin of safety. Made it too quickly, and now I'm paying the price with quite a bad return rate there. It would still be quite negative, but not as bad as that. However, I will potentially hold. It's a low debt, low chance of failure company. There's still upside there. It's just going to be a tricky sort of 12, 24 months potentially. Let's see what happens. But I've got a mutual fund here, Linsell Train UK Equity, up 15 points now. So I'm almost back to 100% on that, where it was last year. Currently holding that. That has compounded very nicely for me. And we've got a UK smaller companies fund as well that's done very well in the last month, up 19 points, 111% total. Again, I've had this one, some of my legacy holdings from before starting the £1 million challenge. This has been going at like 13% a year, 12, 13% a year for quite a few years. So happy to carry on with that one. And Aviva, one of my favourite insurance companies. I do like insurance companies, especially these older ones. about £1,000 in that, 44% return, a decent dividend. There was the issue with the return on capital, but that's all worked through now. That's done and dusted. I'm just going to carry on holding that for now for the dividend. FTSE 250, again, as for reasons mentioned for indexes, just under 1,000 in that, and up 11 points this month. So it's been a good month in the markets, at least for the smaller companies. Now, Unilever's had a really good month, up 8 points, so 92% total, almost back to the 100% club where it touched last year before dropping off. They came out with good results recently, which is why this has edged up to about £40 a share. Dividend-wise, I think I'm over 5% on cost. Good return on capital employed, if memory serves. It's just a good hold. And Investec, I really like this company. Bought it at about a third of book value. It's up 223%. Really good month, and I get a really good dividend. I think on cost it's over 10% now. Now I did get some spin-off shares of 91. So you'll see an entry for 91. I didn't buy the stock. It's a spin-off share, so a demerger part of Investec before. Yeah, going to carry on holding this. Really happy with them. And they're targeting return on equities, I think, in the sort of 16% range, if memory serves. So that's not super good, but it's pretty decent. So I'm happy if they're thinking in those terms to carry on holding. K3 Capital Group, one of my favoured smaller companies. Lots of insider ownership, pay a dividend, up about 25%. It almost got to the point where I bought more. It had gone below £2 a share, I would have bought more, but it went down to about £2.15 and didn't quite go below £2. So I waited. That's my trigger on that one. It's quite an interesting small company. Worth having a look at for a bit more research if you're after one. That's down a little bit this month, but just long-term dividend hold. Happy to carry on with that. Not planning on doing anything there. And we're in for Legal and General. So again, a nice long-term dividend hold, insurance company. Well-established company, a bit like Aviva, just over 500 quid, decent returns so far, like the dividend on cost, so carry on holding that. And I'm a customer as well, so all good really. Now BT's down 20 points in the last few days. There's been their results that have come out, and also there's the strike action talk, and it's absolutely hammered the share price. Bit of an overreaction. I'm only up 41% on this now, and I was up much more than that at one stage. I do think there's a lot more upside in the company. Clink is a nice dividend hold. So I'm actually pretty much back to cost on this. I think I paid £400 for the shares. But my total return's actually up 19%. And that is because of the very nice dividends that they've been paying. So very happy to carry on holding them for that dividend. Direct Line's taken a bit of a battering with their results in this month. Which is why they're down 13 points. But yeah, good dividend payer. I suppose compared to the other insurance companies, I don't think they're perhaps quite as good as Aviva and Legal and General. So it may be one to divest myself of for a bit of portfolio simplification. I'm conscious there's too many holdings. I have said this before. It's not just a case of going, let's for us just sell 10 arbitrarily and try and sell them at the right points. Not just go and rush and sell them just to reduce holdings. It's very hard actually to know when to sell. Finding that quite difficult. Now Plus 500 continues to outperform, which is why it's up 16%. They're doing buybacks, doing dividends, they're beating expectations, they've raised guidance. Very happy to carry on holding them, therefore. Duke Royalty is another one that I hold, which has grown nicely, which pays dividends, alternative finance, really, about 50% or so. I think there's a lot more upside in that one. Right into the smaller holdings. So S4 Capital, I think they dropped almost 50% in a day when they released their results. Well, in fact, they lowered EBITDA guidance 160 to 120 million, I think, and that was an absolute crash in the price. So I added sort of £1.20, £1.25 range. So that position's increased. I'm not planning to add more really, but down 42%, but that's better than it would have been. This should do well in the long run. Certainly, I'm expecting at least 100% on this. We've got a small fund here. Maybe I should sell it just to keep the portfolio a bit simple because there's only £100 in it. And then 91 that I mentioned earlier is the spin-off, £43, almost negligible. Probably wait for the dividend to come in and then sell that one just because it's so small. I don't think it's a buy for the portfolio. Not sure about the valuation. And we've got the Argo blockchain again, just totally collapsed as a side crypto play as Voyager did Bitcoin miner. So yeah, that was always a risk with those. So we hit the Asia Pacific portfolio now. It's about 5,000. It's dropped a bit in the last month. So around just under an eighth of my overall portfolio. So let's find out why it's dropped. And the key reason, as you can imagine, is Alibaba down 15 points. They released some results and they were doing really well in terms of the market price at least, and it's now dropped off a lot. So I'm down 37%. So that's a big reason why this portfolio is down. Dropped 15 points in the last month. With a Camera holding, it could take years and years for this to get back, but it will get back. It will do well because the company is a good company. Now, this fund, I've been thinking a lot about this Asian income fund, and I actually deduced that I'm going to sell it. I mean, it will first of all give £900 cash into the portfolio, which would be great. I made 84% on it, also great. However, it actually overlaps, doing a bit more research, so it overlaps with my existing holdings, which is an index fund. And therefore, based on the charges, I'm just considering what to do with this one. So I think I'll sell this one, back the profit, make sure I'm not losing too much money on charges. Over the long run, most all active fund managers don't outperform their respective indexes. It's a very small percentage. So that will help with some of the portfolio consolidation. China index, exactly what it says on the tin. Again, for reasons that I've described previously. So this is the index that I just referenced where there's the overlap. Hold this index, and then if there's any big dips, I'll add to it. Now, Kelly Partners Group is a very interesting one. It's a very, very small cap Australian stock. But the only way I could find it was through the Interactive Brokers platform. And I've got a link for you down below if you're interested in joining that platform. That's had a really good month, up 27 points. Total return 65%. So it's doing very well, pays dividends, also growing. Very happy with this one in the portfolio. Now, Hui is an interesting one. Chinese stock, about 1% of the portfolio. It's down quite a lot, and again, my entry level position for growth stock wasn't taken with a margin of safety, so that's definitely something I need to improve on. Australia Index does what it says on the tin, again covering points we've already mentioned. So that brings us to the end of that portfolio. I just thought I'd show the Treemap for all of my portfolios combined. You'll actually see now the cash box, so the red box, that is now much larger than it was before. I'm around about 10% in cash. That's actually bigger than any of my holdings. Looking at that diagram, it does show that there probably needs to be several less. I think ideally I'd have a maximum of 30 positions. That's where I want to get to. Heard as I've gone through, there are certainly plans to dispose of several of these. And there'll be several more, hopefully this year, for example, the coal positions. And what I want to do is act with a lot more conviction when I find very, very good opportunities for the margin of safety going forward. So the progress that you've been waiting for. So my stretch target, if I want to hit the million by 2050, I need to be at 38,536 by the end of this year. I'm now above that. I'm at 39,753 for the end of July. And of course, there'll still be August, September, October, November, December. 5 lots of 300, at least 1,500 quid more to go in for the end of the year. So since last month, £300 has gone in line with the minimum requirement. And then the overall value of the holdings has gone up £805. So I'm up in July, a decent amount. Yeah, happy with where it is. So thank you very much for watching. Appreciate your time. It's been a longer one. I wanted to get that explanation out there for the holdings. But if you are looking for bigger portfolio, if you want to get more money into your portfolio and you're struggling of how to actually increase the money in, check out the video that's linked on screen now, because I've reviewed a book that may be able to help you with just that very thing.